Second thoughts about Bakhmut and Ukraine, about Chinese economy, and about where the Fed is heading. This is Bloomberg Wall Street Week. I'm David West. This week, special contributor Larry Summers of Harvard on Silicon Valley Bank and the risk of contagion.
I don't see, if this is handled reasonably, and I have every reason to think it will be, that this will be a source of systemic risk.
Afsaneh Beschloss of RockCreek about the politics and returns of ESG investing. And investor Sam Zell about what ports to seek when the storms are coming in.
We're talking about ending free money, but we're not ending free money.
This week was a time for reconsidering on global Wall Street as the war in Europe raged on and Ukrainian forces fought valiantly to hold onto Bakhmut.
Bakhmut is surrounded on three sides. Reportedly, the calculation Zelensky's making is that he'll wear down Russian forces, which are not very capable.
Even as leaders like Jamie Dimon of JP Morgan warned that the situation there poses one of the biggest risks to the global economy.
The thing I worry the most about is Ukraine. It's oil, gas, the leadership of the world, and our relationship with China. I mean, that is much more serious than the economic vibrations you all have to deal with on a day-to-day basis.
At its National People's Congress, China's leadership laid out new, more modest projections, raising questions not only for China, but for global growth.
If you look at the trends of the GDP target they've set over the years, actually since 2018, they've been gradually lowering the GDP growth target. So I think this is also a sign that increasingly the policymakers are increasingly emphasizing on the quality of growth rather than quantity.
While Fed Chair Jay Powell left little doubt that the continued strength in the economy makes higher rates more likely than lower.
The latest economic data have come in stronger than expected, which suggests that the ultimate level of interest rates is likely to be higher than previously anticipated. If the totality of the data were to indicate that faster tightening is warranted, we'd be prepared to increase the pace of rate hikes.
And the prospect of those higher rates hit tech banking hard, as Silicon Valley Bank went from panic to receivership in 24 hours.
SVB Bank has now failed. The FDIC takes over and has appointed a receiver. It is the first insured institution to fail so far this year.
Jobs numbers out on Friday would have been encouraging, but for that SVB's failure, with the U.S. adding another 311,000 jobs, while wage increases slowed a bit. But all the jobs in the world couldn't overcome Chair Powell's warnings about higher rates, and then the shudder sent through the banking sector, leaving the S&P 500 down over 4.5% for the week, while the Nasdaq lost 4.7%. But, of course, the flight to safety drove investors to bonds, leaving the yield on the 10-year 25 basis points lower on the week, with almost all of it really coming on Friday. Here to help us sort all this out are Sarah Ketterer, Causeway Capital Management CEO, and Barbara Reinhard, Head of Asset Allocation at Voya Investment Management. So welcome to both of you. Barbara, great to have you here with us. So it was quite a back and forth week. We had the Powell testimony that seemed to indicate we were going to go higher. We had the jobs numbers, and then we had the SVB situation. What do you make of all of it?
Look, I think that the overwhelming thing that happened this week was the receivership of SVB, right? It's one of the largest bank failures that we've had since the financial crisis. It's the 16th largest bank in the U.S. I don't think that the issues that you see with SVB are systemic. I would agree with what Larry Summers has said earlier. However, I do think it was an opportunity for everyone in the market to take a very big pause today and really think about their positions and think about their liquidity, which is why you saw some of the, less liquid parts of the market really get hit much harder today, like small cap stocks and high yield bonds also, were down pretty dramatically today.
So, Sarah, even if it's not systemic, is it possibly a canary in the coal mine, as they talk about? Although it may be just SVB and they got special situations, the underlying circumstances could be reflected in other parts of the economy, as well as, frankly, financial markets.
Well, David, one never knows, but Silicon Valley Bank did have a very concentrated corporate deposit base, and so there are other regional banks in the U.S., their deposit bases in general seem to be much more diversified. So that's one of the primary reasons why this may not be systematic. But confidence is crucial for banks. And there doesn't appear, especially given the likelihood that Silicon Valley bank depositors will be made whole, any reason for this to spread through the banking system, which could be a reason to be looking at some of the other banks as investments, given they're selling off so rapidly.
Well, it wasn't even, I don't think, as a practical matter, Sarah, by the time it started to sort out, it looked like the regional banks were getting hit harder than the big money center banks. Does that suggest that some of the regional banks may be opportunities for investors right now?
It does depend on what they hold. If in their asset bases they have a huge amount of commercial real estate, particularly office, that could end up being very problematic. What we're all really talking about here is a new era. Interest rates are rising, and until they stop rising and fall again, there's a complete new view on credit. Credit is going to be very difficult to obtain. We're in a credit crunch. So whether you're in real estate and you have a tough time with occupancy, or you're a technology banker, this is a whole different environment. So be really careful if you're looking at regional banks. Make sure if they're trading down at their tangible book value, book less goodwill, that's really solid ground. There's nothing else that could go terribly wrong on their asset side of their balance sheet.
Barbara, what other parts of the economy and of business are interest rate sensitive in this sense? Because we've had a long regime, frankly,
right,
of pretty low interest rates. That seems to be gone.
Right. Well, look, who's benefited the most from very low interest rates? You know, the real estate sector was probably the first one, right? That's the single biggest beneficiary of it. You'd have to also take a look at the private markets, private credit, private equity, private real estate, all benefited from very low rates. So, you know, the fact that you have is drying up liquidity. The Federal Reserve has been raising interest rates aggressively for the past 12 months. They're trying to slow down the economy. And when you slow down the economy, certain things break. Just like cryptocurrency broke last year, then you had the problems in the gilt market in the UK, and now you have a U.S. bank that's just failed.
Try to slow down the economy. How much, Barbara? Are we going into a recession as a practical matter? Because the inflation seems to be more durable than people thought. Mm-hmm. Are they going to have to step on the brakes so hard that we have to go into recession?
I don't think there's a recession on the horizon over the course of the next 12 months, right? There's a very long lead time between policy implementation when you're raising interest rates and when you would go into recession. The U.S. economy is extremely strong, right? You had 311,000 jobs printed this past month. While it looks like the labor market is starting to ease a bit and weaken a little bit, I would say that the U.S. economy is a very durable supertanker. It would probably take a seismic shock of some sort in order to derail it at this point. And I don't think SVB is that shock.
Sarah, you specialize in equities in particular, investing in equities. When it comes to equities, what is your base case on recession? And more importantly, does it matter? Does it really affect which equities you invest in, whether you think there's going to be a recession or not?
It matters if a stock doesn't already price in some slowing. There's no doubt. I mean, my colleagues and I really do believe that the Fed is intent on slowing the U.S. economy. And the same with the European central banks. Maybe they're a year behind the Fed. And at some point in time, maybe the Japanese will tighten monetary policy with a new central bank head. So there's a lot of tightening out there. And the other side of that is typically economic slowing. That's what brings down inflation. And inflation is the target. So we're expecting some element of slowing. It may be severe. It's hard to know. But what we do know is what's priced into stocks. And not all stocks, but in certain areas, that many of them have already discounted an economic slowing. Not all the cyclicals, for example, but there are sub-industries that have. And that's the opportunity where it's already priced in. Then we can have it. Then the worst can happen, and the stock has nowhere to go but up.
So, Barbara, let's play the parlor game. What do you think the terminal rate's got to be for the Fed to get inflation down to where it needs to go?
I don't think it's as high as probably what the market's pricing in. I think maybe the Federal Reserve has to tighten one, maybe two more times, if that, and then be done. The reason is the way that you price in a higher terminal rate is either you have faster labor force growth or faster productivity growth. The U.S. doesn't have any showing of that being the case at this point. So for us, we do not believe that our star is 6% or something above there at this point. I don't think that the U.S. economy can grow so fast, or it's been such a dramatic change that it's been over the past 20 years. So we don't think that rates have to go much higher at this point.
Sarah Ketterer and Barbara Reinhard will be staying with us as we turn to what all this means for your portfolio. This is Wall Street Week on Bloomberg.
in darkest Washington. The Reagan administration stuck to its proposed $695 billion budget, a number that in Washington is somehow regarded as lean and austere. And the Democratic leadership in Congress stuck to its view that the budget is, as one senator put it, cruel, inhuman, and unfair. Tune in next week for further non-surprises.
That was Louis Rukeyser back in March of 1981 when the #1 movie in the country was Back Roads with Sally Fields and Tommy Lee Jones. The #1 song was 9 to 5 with Dolly Parton. And the proposed federal budget was a whopping $695 billion instead of the $6.9 trillion proposed by President Biden just this week. Still with us are Barbara Reinhard of Voya Investment Management and Sarah Ketterer of Causeway Capital. So, Barbara, let me start with you here. We want to turn now to the question of with the portfolio. This is your job in part, is to figure out how to allocate portfolios. Given all that we've said about where we are and the tightening curve, everything we've seen, how do you manage your portfolios these days?
One thing that we're thinking greatly about, David, is our international equity exposure. So when we think about global equities, we look around the world and we look for the opportunity set. One thing that stands out to us that's probably a little bit overextended at this point is international developed equities. Over the past 1 year, the S&P is down 4%. International developed equities, Europe and Japan, are up almost 7%. That is a very big disparity in returns between those two parts of the world. For Europe, it had been priced for a very big, very bad recession. It didn't transpire. They had much warmer weather than had been expected. But we don't think that all those great things that Europe averted, or the luck that Europe had in averting some of that disaster over the past year, is likely to be repeated. So we're actually keeping our assets closer to home in the U.S. We think that the Fed is one of the first central banks or major market central banks that has raised interest rates. It's likely to be one of the first ones to stop. And we think as the world slows down, the dollar is likely to get a little bit stronger as a flight to safety and somewhat quality in the U.S. So we're staying a little bit closer to home, but we're barbelling it with some exposure to the emerging markets because we do realize that there's been a lot of stimulus put into the pipeline. And we think that, again, emerging markets are so cheap at this point. If you can hold them for a 3 to 4 to 5 year period, you're likely to be very pleased with your portfolio.
Okay, Sarah, so to some extent, Barbara's talking your equity book here. You specialize in equities. Where are you in developed market equities these days?
Well, for developed markets, and Barbara has a point, that Europe and Japan have outperformed the U.S., really more Europe. The Euro Stoxx 50 is up 11% year to date in dollars. That's not even a full 3 months. However, that's a rather short time period. Non-U.S. developed has vastly underperformed the U.S. over the last decade. And I've heard this from clients. They get very anxious. But so it might be quite some time, if you think about it in that longer context, for non-U.S. developed to catch up with the U.S. And there's still a significant valuation discount for non-U.S. versus U.S., in part due to the different sector weights in the two areas. The U.S. has much more in the way of technology. And year to date, interestingly, in a broad global context, technology has led, along with consumer discretionary and communication services. So investors are still really interested in tech. There's, I just say, this is the environment we're in. It's one of active management. With rising rates, you just can't buy an index anymore, in my opinion. You have to have a manager who can sift through and, let's say, go to non-U.S. developed and find the stocks that haven't yet had their earnings recovery recognized. Some of them haven't even gone into a downturn. I mean, Barbara noted the tightening cycle, and I mentioned this as well, is a little bit lagged in Europe. Well, with all that additional tightening, there may be more casualties. So being very careful about price entry point, being extremely cheap in terms of what you'll pay, is a way to avoid those pitfalls.
So, Barbara, you are responsible for asset allocation at Voya.
Yes.
As you look at that, do you agree that the days of beta are largely past us? We got to really go with alpha. We got to make stock picks.
Look, we at Voya, we have both products that go in active and passive management. We're very focused on fees for our clients. We're managing money for retirement. And we know the single best thing we can do is keep our costs low. That helps that compounding of returns over time. There are periods when active management goes in and out of favor. I think it was a really difficult road for active management for a while, but we find pockets of the market that are very strong for active management. U.S. small caps are a great place for active management. The value sector also very good in active management, but I would say for the lion's share of it, we do try to really keep our fees as low as possible, which generally means in the big cap places, we tend to go passive.
So I'm curious, Sarah, there's a lot of discussion obviously about fees when it comes to active versus passive. As an active manager, how do you make sure you don't lose all of your gains in the fees?
Well, just be very careful with fees. But the others deliver significant gains. And if I think about the stocks that a value manager like Causeway would own, we're constantly looking for what the market hasn't yet recognized. And that's very difficult to do in passive. Passive is wonderful if there's monetary accommodation. And that's the environment we were in until a year ago. It was just a year ago the Fed started raising rates. And now assets don't all rise. And that's the difference. So, for example, the advertising industry has been really tough, or the market for advertising. So stocks like Alphabet have been awful. But at some point in time, the valuation will be low enough, and then the stock will cycle back up again. That isn't going to be captured necessarily in an index. It just keeps falling in its weight. And so you don't get more of it, you get less of it. And conversely, in an index, you get a lot of what's already done well. And that's all fine if everything is doing well. But we're in a totally different environment now, thanks to central banks.
It's been really great having both of you with us. Thank you so much to Sarah Ketterer of Causeway Capital and to Barbara Reinhard of Voya. Coming up, we go through the saga of ESG investing, caught between the politics and the markets, with Afsaneh Beschloss of RockCreek. That's next on Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Weston. Investing related to environmental, social, and governance issues, so-called ESG, has been on a roller coaster ride, from being all the rage and embraced by some of the largest financial institutions in the world to being scorned and even the subject of legislation to limit its use. And through it all, it's sometimes hard to sort out how much is investing based on social values and how much is just pursuing value through taking into account all the risks. Afsaneh Beschloss, CEO of RockCreek, was an early proponent of ESG investing, at least in certain circumstances, and she's back with us now on Wall Street Week. It's great to have you here, Afsaneh.
Great to be with you.
Such a treat. So I mean, take us through this. Is it a choice between return on the one hand and social values on the other? Because that's the way some people like to put the question.
You are absolutely right. And I have to tell you, I don't necessarily like the word ESG, just to put that on the table right here. But I think what is happening right now in Washington, President Biden did veto the bill that was trying to pass through to allow corporate pension plans to consider ESG factors in their investments, not to actually necessarily adopt them, but to actually consider them. So it was a pretty soft requirement. I think that what that is not showing us is what you said, which is right now, if you and I were investing in, let's say, renewable energy, we would have lost this year, just in 2023, 1.4% or so. Of course, today the markets got pretty murky, but if you had invested in oil and gas, we would have lost 3.8%. In the last 5 years, we would have made 17.4% in renewable energy, and we would have made about 7 to 10%, depending on which index you're looking at in oil and gas. Now, if you looked at other periods, oil and gas might very well be ahead. But what does that mean? It means for investors, renewable energy is really economic. It has now changed the technologies with us such that clean energy happens to be economic. So when you're looking at purely financial decisions, it should certainly be part of your portfolio.
So I wonder, if I can put it this way, how much of that's on the fundamentals? That is to say, you can actually make more money by taking environmental. I'll just take environmental, so I won't bother with ESG, okay? And how much is actually just the hydraulic pressure behind environmental investing? It's so popular that money goes there and it drives it up, rather than actually being on the fundamentals.
So just purely on the fundamentals, just purely on the cost of how much it costs now to produce solar energy, if you look at that, it has become totally fundamentally economic. If you look at Texas, because we see Texas and Florida are right in the front of the conversation that you mentioned, but Texas is producing 14% of renewable energy in America. Do you think, that would be the case if the fundamentals were not there? They're just as we speak building a huge wind farm that will produce energy for 3 million households, just because it is cheaper than the existing oil and gas. So what you have, let's say in Texas, is the oil and gas community is continuing to produce oil and gas because you need that for the transition, but they are also moving into putting more of their money into wind energy and solar energy.
Afsaneh, you've been in the markets for a good long time. You've observed all sorts of different positions. Will the market sort this out? That is to say, if you're right that in fact you'll get better returns on average over time by taking into account environmental concerns, yes, will that drive people into those investments, whether they want to be there or not?
I actually think people are moving in that direction. So there is one thing is the political conversations that are going on, but if you talk to any businessman, again, not just in Texas, but all over the country, people are investing in an integrated way into these sources of energy, and they'll continue. And insurance companies, by the way, are looking at the same factors to make sure they don't lose money. It's very much, it's how the job is how do you maximize returns, how do you minimize risk. Both of those are very important for investors.
So I'll just again say with climate rather than social and governance for the moment, has it gotten a bad name because some people are using it as a marketing technique? It's actually hard to know which companies are actually making decisions based on it as opposed to just saying they are, because everybody wants to say they're environmentally correct.
I think you're absolutely right. There's the greenwashing, the green bonds led to some companies that were even using coal, calling themselves green. So climate has become not such a positive word, just like ESG. But if we just talked about energy transition, I don't think many people would disagree. We need to use oil and gas. Most people are using them in the transition. But we're moving towards cheaper, sustainable energy. I think everyone is doing that, whether you're looking at Saudi Arabia, UAE, or Texas.
Let's go international just for a moment. Actually, we talked today with the U.S. nominee to head the World Bank, Ajay Banga. You know him well.
Very good friend and great inspired choice.
And I wonder, though, is the United States and Western European countries insisting on some of the poorest nations in the world to go entirely to zero emissions, no fossil fuels, when in fact that's not happening in the United States, it's not happening in Western Europe. There's a transition, as you're talking about it.
So if you talk to the Minister of Energy in a place like Nigeria or Indonesia, they would say maybe it's being a little hypocritical that we're all using in Europe and in the US coal and oil and gas and telling them not to invest in their natural gas industry to replace imported coal. And I think you need the hydrocarbons in these countries during the transition. At the same time, solar and wind is equally cheap. So if I was in their shoes, I would be exporting my gas over to Europe and using my solar.
Is RockCreek getting an advantage by using ESG?
Oh, I would say not an advantage, but we are making some of our best investments, investing in fuel aviation as we speak, looking at new fuels for some of the biggest airlines in the country. We are looking at energy storage. We're looking at carbon capture and EV charging. And those are some of the best investments you could be making.
It's so wonderful to have you here, Afsaneh, always. Thank you so much. That's Afsaneh Beschloss of RockCreek. Coming up, whether it's the risk of climate or the risk of higher rates, investors have a long list of issues to sort through. We go through some of the big ones with famed investor Sam Zell of Equity Group Investments. That is coming up next on Wall Street Week. And we, of course, are on Bloomberg. This is Wall Street Week. I'm David Weston. Well, global Wall Street had a lot to digest this week, certainly with Chair Jay Powell's testimony in Congress and also a huge budget coming out of the Biden administration. What we need here is to know how an investor should process all this. So we went to one of the very best, the most sophisticated, the most knowledgeable. He's Sam Zell. He is the chairman and founder of Equity Group Investments. Sam, great to have you back on Wall Street Week.
Pleasure, David.
Let's start with the Fed and Jay Powell. He sort of said a message, we may have to keep the rates higher longer. What did you make of it? Where is the Fed headed, do you think? Where should it be headed, given what we're seeing in inflation right now?
To be honest with you, I don't know. And it's very obvious, neither do they. We're in this mess because the Fed didn't do their job over the last 3 years. I mean, when you think about we've added, $7 trillion to our debt in 3 years, this is the Weimar Republic. And if the United States isn't careful, they're going to find themselves in the Weimar Republic.
Well, what about that point specifically? Because the Biden administration, their budget came out, and nobody believes that budget's actually going to get implemented, but it's at least directional where they think they're going. They were going up to something like 110% of GDP in debt, higher than what we had in World War II. They're adding like $17 trillion to the debt over time. At what point does this become not a problem, but a crisis for the United States?
When people don't want to buy our debt, when we're faced with the prospect of losing the U.S. dollar as a currency, as an international currency. And if we lose the U.S. dollar as a reserve currency, we're looking at 20 to 25% reduction in our standard of living. If that was included in the definition of the U.S. debt, maybe you'd get some attention. But the reality is that the Biden administration and Powell have gotten away with not doing anything other than continuing to inflate the bubble. And I think it's very, very dangerous.
Whatever else you think, it looks like we're coming close to the end of free money, where we're basically pushing money into the system across the board. Certain Jay Powell is tightening the screws. You complained about free money. You thought it was a bad thing for investors.
Terrible thing.
If it's ending, what do you get to do? What does that allow Sam Zell to do that he didn't do before?
First of all, your assumption that it's ending is a little naive. I mean, we look at it in the real estate arena, where municipalities are, deferring the ability to foreclose or get people out of a house or get people out of an apartment. And every time the strategy leads to a decision, there's a deferral. And we'll wait another 3 months. We'll wait another 6 months. And so we're talking about ending free money, but we're not ending free money. And or we're ending it at a much slower pace than ought to be called for. So I'm not sure that the assumption that free money is over. And I think we've got some, serious problems. I mean, we've got the classic problems that we've always had, which is if you keep feeding them free money, they get used to it. And then they say, well, where's my free money? And, look what's happened to the housing market. In a matter of, 60 days, the monthly payment has doubled. These are extraordinary times, and I'm not sure we have the leadership, either in Powell or Biden, to basically deal with that.
And as it gets tougher and tougher, for example, to borrow against real estate, you see a lot of pressure, not just in the housing market, but commercial real estate as well. I mean, we saw some big news this week with Brookfield and PIMCO and Blackstone essentially walking away, it looked to me, from big mortgages. What does that tell us? I mean, that's pretty remarkable.
Well, it's both pretty remarkable, it's pretty dangerous. The rule of law is based on everybody, quote unquote, being responsible for their obligations. If the biggest lender in the country, Blackstone, can walk away from their obligations, who else can? And, and if I'm a little guy and I have a 2-flat, and the question is, what do I do? And I pick up the newspaper and I see Blackstone, Brookfield, and PIMCO are all walking away. Why should I feel bad about walking away?
So let's come back to equity group investments for a second. Given where we are right now, I know you only do something like 3 or 4 deals a year, something like that, right?
Yeah, depending on the year, but yeah.
Okay, is this year going to be different? I mean, given what you're seeing, is that creating opportunities for equity group investments?
It will eventually, not yet. The buyers and the sellers haven't agreed yet as to what the price is. The seller is still looking for the number that was on the table, 6 months ago when interest rates were 0. Now interest rates are 3 to 5, and he hasn't adjusted his price. The buyer, on the other hand, is looking at his cost of capital doubling, his availability of capital diminishing, and he's saying, wow, under these set of circumstances, I ought to get a much better deal than I previously got.
So if I can put it that way, that's a form of correction. There's a correction in the marketplace where the buyer and the seller's expectations come into alignment.
Or it's a form of no correction.
Well, that was my question. Is it in the process of correcting? How long will it take?
Well, I think that I think correction is the right word, but I think the correction is going to take a lot longer than everybody expects. I mean, there's a certain, mental set in America of, okay, we've finished this version, now let's start the next version. And there's never, ever an adjustment for what it takes to make that transition, to cross that bridge.
Sam, you've been an investor in energy and oil in the past. Where are you in that sector now? And specifically, given what we're seeing out of the federal government and others really changing the investment equation when it comes to renewables, is that more attractive now given the government's participation in things like the Inflation Reduction Act?
Boy, I'd like to think you're right. And I'd like to think that that's exactly what's happening. I don't think that's right. I don't think that's what's happening. I'm wondering when 2035 comes and you can't build any more, carbon cars in California, what are they going to do? I don't know. But I know for sure we're not going to complete the transition from carbon to non-carbon or to renewables. It just can't be done within this period of time. And I think that the question becomes, how much can society sustain? In other words, how much change can we actually pay for? How far can we go and say, okay, we're going to, move to, renewables? Well, I'm in favor of mom and apple pie and renewables and, all those wonderful things. But the reality is, first and foremost, I got to decide what's feasible. And I think that, 90% of what's being done is infeasible.
So, Sam, let's put you in charge of the economy. You can have the White House and the Fed all put together. What would you do to address the debt problem, the deficit problem, the growth problem? What is the thing you would do that we're not doing now?
Accepting reality. Accepting the fact that, we've got a major transition that's going to have to happen. We can't sustain a carbon controlled economy for obvious reasons. So we have to say, okay, how do we get from here to there? And the way to get from here to there is not spending money or following Obama's ideas of dropping piles of money, on things that don't make sense. So I think we got to slow down the process. We got to face up to the reality. We got to say, this is going to take 25, 30 years. We can have the best of intentions. And I really believe we can have the best of intentions. But it still requires time and effort and commitment. And like everything else, we're always looking for quick, simple answers.
Sam, it's always a pleasure having Wall Street Week. Thank you so much for being here. That's Sam Zell. He is chairman and founder of Equity Group Investments. Coming up, we wrap up our week with special contributor Larry Summers of Harvard. That's next on Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Weston. We welcome now our special Wall Street Week contributor, Larry Summers of Harvard. Larry, thank you so much for joining us here. We have to talk about Silicon Valley Bank. It's been developing toward the end of the week. A lot happened. They pretty quickly went into receivership from the FDIC. What does it tell us more broadly about what's going on in the banking sector or in the economy?
Look, there's still plenty of fog of war here, and we're still all trying to sort through it. There clearly was a big managerial failure. It sure looks like regulators were not on the case in the way they could have been. Right now, it looks like this is not a broad systemic issue, that Silicon Valley Bank and perhaps several other banks, but not many other banks and none of the largest banks, had a mismatch between the kind of deposits they had and the ways in which they had invested their money in longer-term bonds. And so I don't think this is likely to be a broadly systemic problem. But it certainly is going to have very substantial consequences for Silicon Valley, for the economy of the whole venture sector, which has been dynamic, unless the government is able to assure that this situation is worked through. Right now, the holders of uninsured deposits have been told that those deposits are frozen and can't be withdrawn. There are dozens, if not hundreds, of startups that were planning to use that cash to meet their payroll next week. If that's not able to happen, the consequences really will be quite severe for our innovation system. I suspect that ways will be found to at least provide significant advances on those deposits to enable the payment of payrolls. I think the FDIC is going to have to think very hard about how to be maximally creative in using its authorities to assure that this doesn't have a set of collateral consequences for the innovation economy. I don't think this is a time for moral hazard lectures or for talk about teaching people lessons. We have enough strains and challenges in the economy without adding the collateral consequences of a breakdown in an important sector of the economy. So I hope that they will, in the short run, be aggressive about containing the problem and containing possible contagion. And then over the medium term, I think there are important lessons for how we regulate, what roles we use for market values in regulation that need to be learned from this experience. I think we have tended to have a bit of a romance with the community bank relative to the larger banks, and we're going to have to figure out how to maintain banking services for communities while moving to also pay attention to making sure that we've got as much financial stability as we possibly can.
Whenever we talk about financial stability, we are reassured that the banking system is so much stronger than it was before 2008, 2009, so many reforms. Is there some question now about whether that's exactly right? And let me be very specific. What about the stress tests? Why didn't they kick this out?
Look, I think I have written that there are a lot of concerns about the stress tests. I do not believe the stress tests give an accurate picture of the resilience of the banking system. I think they are far too optimistic in thinking about what would happen in a catastrophic kind of scenario. That said, I think any fair-minded observer has to think that banks are better protected than they were before the 2008 financial crisis. Though I think we have to recognize that a large part of the lending in the country and lending to businesses is now done by institutions that are not banks. And so there are important issues in the shadow banking system. So this certainly should come as a reminder that rational financial regulation is hugely important to the success of the American economy.
Larry, we also got jobs numbers out on Friday this week, and they were more robust once again than expected, 311,000 new jobs. At the same time, the rate of wage increase actually came down just a little bit. What did those tell you about the strength of the economy and, for that matter, where we're headed with inflation?
I think that most of us probably have a kind of now more than ever view after these numbers. If you were a person who is very worried about inflation, you focus on the strength in the economy and the seemingly ever tighter labor market. If you're a person who is less concerned about inflation, you probably take heart from the lower wage inflation number. So I doubt these numbers changed too many minds. I'm going to be watching for the CPI number next week, but I think more broadly, it seems to me that we don't have a lot of evidence of a basic downwards trend in inflation. It looks to me more like the inflation story is fluctuation around an underlying inflation rate of 4.5 or 5. And if that's close to right, it suggests that the Fed has considerably more work to do.
Well, that's exactly my question. What does it mean for monetary policy? What do you think the Fed should take away from these numbers, and what does that mean they should do? For example, on terminal rate.
I suspect that there's a quite good chance that we're going to need to get to a terminal rate near 6. After all, we have inflation running at close to 5%, and we have interest rates at about 5%. And so interest rates and inflation in the same range doesn't point to a lot of pressure to bring inflation down. So I'm very much open to changing my mind, and I think confident pronouncements about these things are a mistake. If we get a strong CPI number on Tuesday, I think the right thing to do will quite likely be to increase rates by 50 basis points in March, because if we're pretty confident that rate increases of that magnitude are necessary, I don't see much reason not to get on with it. If the CPI number is more moderate, then I think or comes in surprisingly low, then I think it's a very different kind of judgment that needs to be reached. Right. In general, I think there is more risk of underreacting to the inflation concern than of overreacting.
Larry, finally, and briefly if we can, what about the budget that we saw out of the White House this week? $6.9 trillion, spending an awful lot more on a lot of things. Are we having a serious discussion about the federal budget on either the Democrats or the Republican side at this point? And if not, how do we get to one?
There are a lot of good ideas in the budget, but I think for a variety of reasons, the deficit path is likely to end up greater than the administration imagines unless there are substantial policy actions. And I think we're getting back into a phase as interest rates rise where it's going to be very important to think about the long-run behavior of budget deficits. In many ways, the picture is more adverse than it was a decade ago when the Simpson-Bowles process was launched. So I do think we need to have that as a bipartisan conversation. I welcome the president's providing his budgetary blueprint and asking the Republicans to provide their political blueprint as a basis for conversation and dialogue. I am glad to see rising focus on containing healthcare costs, because that's probably the single most important issue in thinking about the budget over the longer term. Though I'd have to say that my judgment is that the ultimately necessary expenditures on national security are going to be substantially greater than in the president's budget.
Larry, thank you so much. That's Larry Summers of Harvard. Coming up, whatever you think of ChatGPT, maybe it can help us get rid of some of those pesky lawyers. That's next on Wall Street Week on Bloomberg. Finally, one more thought. The first thing we do, let's kill all the lawyers. Well, that wasn't really my idea. Shakespeare had his character, Dick the Butcher, say it in Henry VI, Part 2. But it's something we've heard often repeated, even by some lawyers like me. Now, for the first time, it may just be possible. Maybe not to kill the lawyers, but to make them a little less necessary. It's a use case for artificial intelligence and all those chatbots we're hearing so much about.
This is ChatGPT.
That is rolling out an AI chatbot service.
As ChatGPT fever sweeps the world.
It's way too early to say where AI will lead us, but it's hard to find anyone denying that it's going to be big.
This could be the most important general purpose technology since the wheel or fire.
With the potential to transform everything from banking, as Jamie Dimon told us this week.
AI is real. This is not crypto. That's not crypto. This is a technology which is staggering, and we're fully engaged.
To hedge funds, according to Ken Griffin of Citadel.
This branch of AI will be game-changing for the economy. And like most changes in technology, with clear winners and losers.
To IT, with HPE CEO Neri pointing to AI for his company's growth prospects.
I know AI is top of mind for people today, and that's where is a big opportunity for us as a company.
And now, chatbots are stepping up to the bar, the legal bar, that is, with reports that ChatGPT scored a passing C+ on a standard law school exam at the University of Minnesota. Now, that's not good enough to make law review, but a passing grade it is nonetheless. And that may just be good enough for routine contracts and memoranda at global law firm Allen & Overy, which has been using its own chatbot dubbed Harvey, eerily similar to the HAL of 2001, A Space Odyssey.
And I want to help you.
Not to be outdone, major international law firm DLA Piper said this week it has hired a new chief data scientist to oversee 10 as what they call top-tier data scientists for its new artificial intelligence and data analytics practice. But for all the anticipation of a brave new world, it's a little hard to imagine a chatbot, no matter how smart, taking the place of a good old country lawyer.
I've been appointed to defend Tom Robinson. Now that he's been charged, that's what I intend to do.
That does it for this episode of Wall Street Week. I'm David Weston. This is Bloomberg. See you next week.